In February 2025, Vanguard, one of the world's leading investment management companies, announced its most significant fee reduction in nearly 50-year history. The firm has lowered its expense ratios across 68 share classes across 87 different funds, and this is going to include all the mutual funds, index funds, and ETF share classes, resulting in an estimated $350 million in savings for investors in 2025 alone. So we got to understand the expense ratios and as well as their expense impact. So why does it matter? Expense ratios represent the annual operating costs of a fund expressed as a percentage of its average net assets. These costs include management fees, administrative expenses, as well as other operational costs. A lower expense ratio means that a smaller portion of that fund's assets is used to cover these costs, leaving more of the investment returns for the investors. So over time, even minor reductions in expense ratios can significantly enhance an investor's net returns due to the compounding effect. Since its founding in 1975 by John C. Bogle, Vanguard has been dedicated to minimizing investment costs for its clients. The company's unique client-owned structure allows it to operate at a cost with profits returned to investors in the form of lower fees. This recent fee cut aligns with Vanguard's long-standing philosophy that lower costs contribute to better investor outcomes. And for the past 10 years, 88% of their equity funds have outpaced average results of competing funds. So Vanguard's performance has been very solid, and 88% have outperformed other funds by brokerages such as Fidelity and Charles Schwab. Now here's the interesting thing. The performance of our actively managed fixed income funds has been even better. So 91% of their active bond funds and 100% of their money market funds have outpaced their peers' average results. Now, if you're not familiar with a money market fund, that's basically where your money sits that is uninvested. So if you have some cash sitting that is not in any stocks or ETFs, it's basically in a money market fund, and it typically acts as a high yield savings. It has a very high interest rate, and in some cases, it actually has a higher interest rate than a regular high yield savings account. So it's a pretty good place to park your money and earn interest. And it's also interesting that 91% of their bond funds have outperformed its competitors, and especially in a market like this, a lot of people are cashing out of the market and placing their money into safer assets such as bonds. Now let's take a look at what the CEO of Vanguard has to say about the largest fee cut in Vanguard history.
I'm Greg. Some very exciting news we have to share with investors. Vanguard announced the largest fee cut in our history, lowering expense ratio across 168 mutual fund and ETF share classes by a total of more than $350 million this year.
Yeah, it is really exciting. This fee cut speaks to what our founder, Jack Bogle, set out to do, which was create an investment company that was designed for one constituency, and that's our investors. Bogle had a great phrase, you get what you don't pay for.
That's correct.
There's a false dichotomy between do you want great performance or high quality, or do you want low costs? But at Vanguard, you can get both. This is over $350 million of estimated savings, the largest expense cut in our history. Since 1975, we've actually reduced our fund's expense ratios more than 2,000 times.
Lower fees mean fund investors can keep more of their returns and a competitive edge.
This is very good to see, especially since they're continuing John Bogle's legacy of low expense ratios. This definitely aligns with his vision. Now let's get over what happened and what expense ratios are being reduced for their funds. So as we can see, the largest share classes with reduced fees are going to be these 10 right here. 5 of them are going to be bond and short-term reserve funds. And as we can see, we have total bond market index fund, VBTLX, and it's getting reduced from 0.05 to 0.04% expense ratio. We have the Treasury Money Market Fund, 0.09 to 0.07%. We have Intermediate Term Corporate Bond ETF, 0.04 to 0.03%. We have Short-Term Investment Grade Fund, 0.1% to 0.09%. And we have the Tax Exempt Bond ETF, 0.05 to 0.03%. So these are some pretty significant cuts, and it already has very low expense ratios, but these funds get even better with even lower ratios. This means that investors are going to keep more of their money, and especially in this economy, when a lot of people are putting their money into these bond ETFs and index funds, it really helps investors maintain more of their capital. Now, of course, we have stock funds. So for some pretty significant rate cuts, the FTSE developed markets, which is going to be international markets that are being developed, 0.06 to 0.03%. So that is a 50% cut, which is pretty significant. And of course, we have a dividend appreciation ETF, 0.06 to 0.05. Now, a lot of people are going to enjoy that one. I know a lot of my viewers are invested in VIG, the dividend appreciation ETF. Then we have VGT, which is a very nice growth ETF, information technology. It's going from 0.1% to 0.09%. And then we have emerging markets, VWO, 0.08% to 0.07%. And of course, we have VXUS, the total international stock ETF, 0.08% to 0.05%, which is a significant reduction in expense ratio. And here they're claiming that the Vanguard funds are less expensive than ever. And we also have to consider that overall, 86% of Vanguard mutual funds and ETF asset classes are in the lowest cost deciles of their peer groups. And the average expense ratio for their index fixed income ETFs is only 0.037%. So that means for every $10,000 you have in the ETF, you only have to pay about $3 to $4 in expense ratios every single year, which is not a lot. Their active fixed income ETFs have an average expense ratio of 0.1%, which is the lowest among leading issuers of such ETFs. Now, as we all know, actively managed ETFs and index funds have very high expense ratios because it does take a lot of manual labor. So seeing they have an average expense ratio of only 0.1% is pretty sweet. And 100% of their actively managed fixed income funds are now in the lowest cost deciles of their peer groups. So this is pretty sweet for investors. These fee cuts mean direct cost savings and potential for higher net returns over time. Lower fees reduce the drag on investment performance, allowing a greater portion of the fund's return to benefit the investor. This is particularly advantageous in low return environments where minimizing costs become even more critical. And considering that the S&P 500 index is down around 15% year to date, a lot of people are really relying on these fixed income funds. And what better time to invest in those bond ETFs when Vanguard is lowering the expense ratios. Now in the future, we hope to see some other funds get reduced expense ratios. One of the popular ones is going to be, of course, VOO, the S&P 500 ETF index. And it already has a low expense rate of only 0.03%. That means for every $10,000 you have invested in the ETF, you only have to pay about $3 every single year. And this is very good for competition. We saw this with the rise of Robinhood and the $0 fee commission trading. A lot of other brokerages had to be competitive to maintain their consumer base, and also they had to actually eliminate their own commission fees to remain competitive to Robinhood. We're already seeing competitiveness from other brokerages such as Fidelity with their own zero total market index fund, FZROX, which actually has no expense ratio for being an index fund. So just like Vanguard, Fidelity has also been coming out with very low expense ratio funds in order to maintain and attract investors to make sure a lot of their consumers keep their money in their platform. So this is very good to see, and Vanguard's moves places pressure on other major asset managers to consider similar fee reductions to remain competitive. Firms like BlackRock and Charles Schwab may need to reevaluate their fee structures in order to respond to Vanguard's aggressive cost-cutting measures. But every brokerage is going to have their own approach, and while some competitors may choose to cut their fees, others may focus on differentiating their offerings through enhanced services or unique investment products. Now, especially if you have a Roth IRA with Vanguard, these fee reductions can be pretty significant because it's going to allow your retirement funds to grow at a faster rate. Even though it's a little bit minor when it goes from 0.04% to 0.03% expense ratio, you are keeping more of your money, and that's always a good thing, especially in this environment.